Good morning, everyone. Thanks for taking some time out this morning. My name is Mike Wilkerson. I'm a partner at a local economics consulting firm, ECONorthwest. We're based out of Portland and have offices in Seattle. This morning, I'm going to be sharing results from a study where we teamed with Up for Growth to produce a series of studies looking at housing underproduction across the country, and earlier this year released the report specific to Washington. In addition to the report's findings, which are available if you're interested on the Up for Growth website, which is Up for Growth spelled out, as you can see in the bottom of the slide here, .org. I'll also be talking a little bit about some recent developments. Certainly the COVID-related pandemic and many other things have changed since we produced the study, and so looking forward to having an interesting discussion this morning. If you have questions along the way, I will be pausing intermittently and looking in the chat to see if there are particular questions of interest, and I'll try to field those along the way. And then at the end of the meeting, I will also be able to field questions. So I think we're going to go ahead and get started here. So a word that we hear probably hundreds of times a day in all forms of media, social, otherwise, is unprecedented. And I think it's helpful to look at a definition of what that means. And so we talk about without previous instance, never before known or experienced. So some of the things we're seeing here are unprecedented, and some of the things here that we're seeing happening recently are probably rare events. What I think is certainly unprecedented is the magnitude of the types of events we're seeing all happening in and around the same time. So whether that's the pandemic now happening since earlier this year, the fires that have been devastating many households in places that we treasure across the West Coast over the past several weeks and months, and then the election on top of that. I think when you start to look at those three types of events happening at the same time, that's truly unprecedented. And so take some time this morning to dig in on some of those factors. I think broadly, we're interested in looking at housing affordability is kind of the theme of what we're organizing around this conference. And so one of those ways that we look at affordability is an average representative household and their ability to pay for rent. And traditionally that's done by looking at area median income, where 100% of area median income would be a representative household. And over time, we can see, if we look in Seattle, Vancouver, Spokane, that housing was generally affordable. It was around 80% of the median, which is considered around workforce housing. And in Vancouver and Spokane, it was in and around 60%, which would be the threshold for regulated, subsidized, low-income housing tax credit projects or federal subsidies. And so there wasn't really a broad affordability challenge going back to 2000 and really through many of the early years in 2000s until about 2010, at which point you could see steep increases in what an average apartment looks like. And here we're looking specifically at one-bedroom apartments, to where in Seattle it peaked at 111%, Vancouver a little over 80%, et cetera, in around 2016, 2017. Since then, rents relative to that affordability threshold have decreased. And so that's not to say that rents are now broadly affordable, certainly in Seattle, because 100% is broadly unaffordable. And for many households, they are cost burdened. But in general, the peak of the affordability crisis is behind us because rents have slowed down while incomes have continued to rise. And so for many households, they've experienced improved affordability on the rental side. Cost burdening is the outcome of where households are spending more than 30% of their income on housing or rent specifically. And so here is a nice graphic that Bloomberg put together with the Harvard Joint Center, where each of these dots is one of the top 100 markets in the US. The red dots are California, because that was the example reference area. But we can see here I've highlighted Seattle. And what this shows is for households that are earning $15,000 to $30,000, 82% of them are cost burdened. And so that's, you can look at that near the top, on par with most of these California markets. As incomes rise, cost burdening decreases, but you can still see even at incomes of $45,000 to $75,000, if you're renting, 41, 42% of those households are still cost burned. And that's on par with many of the most unaffordable places in the country. And I think these are all things that people are familiar with in and around Seattle and the Puget Sound. I think another important related point that we want to try to make is when you look at surveys of some of the major issues in the region, homelessness generally is at the top or near the top of those areas of most concern. And what we're looking at here is a chart that's showing the connection between the rate of homeless populations and rent. And that's it. And all we're looking at here is there's a strong relationship between rent and homeless populations. And that trend line in the dots in the middle is kind of that what's expected. And you can see in Seattle specifically, is near the top. There's only 4 other markets in the country that have higher rates of homelessness. Statewide, homelessness increased 16% from 2017 to 2019, the most recent data we have. And so connecting the two issues, housing affordability and homelessness, is a key part of what we want to reinforce in this study. So let's talk a little bit about housing during COVID. Many of the things that we're seeing are kind of non-intuitive and atypical. So let's talk about what is typical. And generally speaking, many people believe that home prices increase most of the time, but decrease in recessions. And so this is a chart that Zillow's put together. There's lots of going on here, but the big takeaway is that little bar band in the middle is looking at each dot as a state. And in regular economic expansions, you can see the rate of increases in the 4 to 5% a year is what you typically see, although there are some markets and some hot places that might go up 30% a year, and in some instances, markets might drop even 10% a year. And that's in expansions. When we look at recessions, the Great Recession was very atypical. Atypical in that broadly we saw home prices drop. But if we look on the very right-hand side of the chart, looking at every other recession, you can see home prices typically go up. And that's what we're seeing today in COVID. In this recession, which is certainly one of the worst, if not the worst we've seen since the Great Depression, if we look at the last year, August 2019 through August 2020, here you can see, all of the counties in Washington state, and prices are up, 1%, that's 0.01 in King County, 11% in Pierce County, 5% in Snohomish, et cetera, and aren't really seeing decreases in prices anywhere. And that's much more typical of what we see in a recession, but certainly not what we saw in the last Great Recession. One of the strong reasons that we're seeing prices continue to increase is the lack of supply. And so the number of listings in the market is dropping, but the demand and number of transactions that we see is holding steady. And so if you looked at all of the homes on the market, in 1 month, they would all sell. And so that's very low by historic standards. Traditionally, that's been in the 4 to 6 month range. But in Seattle, certainly over the last 8 years, there's been very little supply. In 2018, it kind of upticked at the time when the market had a little bit of a correction in Seattle. But since that time, in the last 2 years, we've seen supply continue to drop from about 3 months of supply to 1 month of supply. And that's happening nationally as well. One of the trends that we're hearing a little bit about related to the COVID pandemic is certainly the ability to work remote and how that's impacting the demand for urban markets versus suburban and more rural markets. And so Redfin looks at a measure, they look at competitiveness. Competitiveness is a bunch of factors. They don't necessarily matter, other than to say Seattle in general is the most competitive or one of the most competitive markets in the country. But within Seattle, we can look at all of these various cities. And if you see at the top, Lacey, Bothell, Parkland, Shoreline, Tacoma, Everett, these are all not your densest, most urban places. In Seattle, Bellevue are near the bottom. And so this is starting to hit out a trend that we're seeing where the competitiveness of what we've been seeing in Seattle, maybe city of Seattle, is now moving a little bit more to suburban and more rural markets. Another measure that they look at is kind of the net migration patterns, where they look at people in Seattle and where they're searching versus people outside of the region and where they're searching. And they kind of understand what normal looks like. And in Seattle, in the last 2 quarters of 2021, you can see there's been a decrease in kind of this net migration as measured by Redfin. So this is kind of an early indicator before we get good migration data that people are looking much more outside of the region and fewer people from outside of the region are looking in Seattle. And if you look at the 2 other markets that they measure in Redfin, why Spokane and Wenatchee, I don't know, but certainly more suburban and rural markets, they've seen an uptick in demand from outside of the region. And so I think that starts to point to some of these trends that we're starting to see in terms of demand for in-close living. On the rental side of the equation, we're seeing the exact same thing. So CoStar tracks this nationally. What they see is, rents are trending down slightly nationally, which doesn't mean much. But certainly the value of this chart is showing that CBD, so central business districts, urban cores are down, 7%, whereas your suburban markets are down 1%. So seeing much more strength in the suburban markets than we are in the central parts of cities. So that's a quick intro into what we're seeing in COVID and an intro to the study. Maybe I'll pause here to see if there are any questions before jumping into the study itself. No questions. Great. Well, let's continue. So the report for housing underproduction was released earlier this year. And so we'll work through many of those findings that are top of mind, and then come back at the end and look at how some of that might have changed in the last 8 months since the pandemic and other factors going on. So at a high level, what this report is really trying to understand is the demand for housing, and that's that relationship between housing units getting built as households form. And what household formation is essentially through migration or children moving out of homes and forming their own households. We can look at this relationship as pretty choppy over time. But what we see historically is, and this is nationally going back to the 1960s, that 1.1 is that ratio. And what that means is for every household that's formed, we've traditionally seen 1.1, or for every 10 households that are formed, 11 units of housing built. The reason for that is a couple of, I think, key points. One, there's always a vacancy rate. And so if we're building housing, there's always going to be a stock of housing, particularly on the rental side, that's vacant. Also, there's a component of homes that are second homes, vacation homes. And so historically, we built about 10% more, and that allows for those 2 factors, along with some demolition of existing stock. If we look back more recently, since 2010, you can see this is way below the line. And so at times, nationally, we were only producing 6 homes or 7 homes for every new 10 households that were formed. And what that did is erode entirely the vacancy rate and force, in some instances, overcrowding and doubling up. And when that happened, it corresponded with the time when we saw housing prices go up in many of the places around the country that experienced housing shortages and underproduction. And the study really tried to identify that at the state level. And so understanding that real estate markets are not state level, they may or may not even be at the metro level, and they're certainly much more local, but understanding in aggregate, if states are building enough housing relative to the demands in there, we've identified these 23 states or 22 states in DC that did underproduce housing, and the data at the time allowed us to look at 2000 to 2015. In Washington state, that was approximately 225,000 units over that period of time. So a large number of units over that 15-year period. Breaking that down a little bit further, we can look at on a county by county basis. And again, the idea here is that we're targeting 1.1 units built for every new household that's formed. And statewide, from 2010 to 2017, only 68 units were built for every 100 households formed, or 6.8. And you can see certainly in the Puget Sound region, that was in and around consistently 0.65. Spokane 0.73, down in Southwest Washington, Cowlitz, Clark County, under 0.8. So pretty widespread across the state. And in some of our less populated areas, we did see numbers go up, and a lot of those are second and vacation homes rather than primary residences. So pretty widespread in terms of the issue in terms of not building enough housing relative to household formation. If we go back a little bit further to 2000, the same trend exists. So Washington State statewide built a little bit less than 1 unit, and again, if the target is 1.1, we can see that it hasn't been producing. Another driver of demand is job creation. And so here, what we're looking at is similarly on a county level, how many jobs were created from 2010 to 2017 relative to how many new units of housing. Historically, the ratio is 1-to-1. So this is looking at primary jobs. So if someone has multiple part-time jobs, we're only looking at that one person with one job. But traditionally, that's been 1 unit for every new job that's created. And we can see when we look across the state, many places are above 2, and in King County, more than 3 jobs were created for every housing unit. So when you look at the number of households formed relative to housing units, and we look at the number of jobs created relative to housing production, we can see in combination, those 2 drivers of demand were really strong, and that led directly to the increases in prices and lack of housing affordability. An important point in the study is we looked at forecasting out over 20 years. And so what we tested was if we built those 225,000 units over 20 years, what would broadly be the benefits to the economy? And one of the benefits is prices would be less than they would be otherwise. And so prices are still going up over 20 years. They would just go up, in the case of Washington State, 4% less than they would have otherwise. And so building housing alone isn't a panacea for solving the affordability challenge. Certainly going beyond that and understanding that the need for housing that's more broadly affordable, whether that's through subsidized units or other types of programs, is going to be necessary for broadly making housing more affordable, but certainly building housing does help. What we wanted to understand was, of those 225,000 units that should have been produced, where were they most targeted? And what we found was those were for renter households, specifically those earning less than 80% of area median income. And so to represent that, we can kind of think about those total number of households growing from 2000 to 2017. But in 2000, there were some units that were affordable in 2017. And then there was a share of units that were unmet in 2000. What we're really tracking here is not the extent of the unmet need in 2000. It's essentially how much worse has the problem got since 2000, since that's what our study is really focusing in on. And so when we look at since 2000, we can see the number of households that are renters that are earning less than 80% is growing far faster than a number of units that are available to rent that are affordable at 80% of AMI. And what that looks like is 181,000 units increase since 2000. Most of those were in King County, 100,000 of those, so a little bit more than half statewide. But again, 181,000 of the 225,000 units are really targeted to renters earning at less than 80% of AMI. So underproduction is really when the number of households in an income range grows faster than the number of units that are affordable to that income range. If we want to look at that statewide, we can see, it's not as pervasive in some of our less populated areas, but it is happening all throughout Puget Sound, in the sense of, if we looked at the number of households today who are earning renter households less than 80% of AMI, 61% of them can't afford their housing. And that corresponds exactly with those cost burdening charts that we saw early on, where lower income households are really having issues of affordability and having cost burdening. So maybe I'll pause here quickly. There are a couple of questions in the chat. So the website where the study is available is Up4Growth. That's spelled out UPFORGROTH.org. You can see there's a national report and then state-specific reports for Oregon, Washington, California. Another question is, has there been consideration to the urban unrest in the downtown core as a reason for more stable rents in the burbs? So I haven't seen studies surveying specifically reasons for why rents have been decreasing more. My sense is that's largely a national phenomenon, and you haven't seen unrest broadly nationally. It's certainly concentrated in places like Seattle, Portland, and other markets. And so my sense is it's much more related to the ability to work remote than maybe other factors, but I'm sure all of them are contributing towards that. Let's continue on and pause again to see if there are any additional questions. And so once we identified the shortage of housing, or underproduction as we're calling it, the thesis that we are testing in the study was, how should we build those additional units, and what would broadly the benefits be economically, fiscally, and environmentally? And so that's what we're going to unpack here. And the way that we did that is we looked at growth scenarios. And those growth scenarios really asked us, where should we think about building and what should we build? And so we used a simplified model of looking at, should we build single family homes? Should we look at missing middle? Or should we look at higher density, say podium and or high-rise towers, to test what those implications are on those three factors of environmental, fiscal, and economic benefits. And so to look at that, what we said was, what are we doing today? And that's more of the same. And what we're doing today is we're building largely single family homes. So 67% of that production has been in those lower density. About a third is in middle, medium density, missing middle, and 4 in that high density. The hypothesis we're testing, and we'll show you here in a minute what that kind of looks like, is in an accessible growth. Accessible growth is really looking to understand, can we target units in areas that are in transit corridors or in areas of high economic opportunity? And in that light, we understand that we could look at drastically reducing the amount of low density development, focusing on missing middle and some higher density product. Through that scenario, we were able to locate statewide 77% of the units within a mile of transit, and 57% of those units within half a mile of transit. And so the key takeaway here is, producing the same number of units only requires 12% of the land area in an accessible growth strategy versus continuing on in the more of the same. So what that looks like here in the Puget Sound is, you can see, and again, this was back in through 2017, we were looking at which areas have the capacity to absorb additional production. And so you can see here what that map looks like. Overlaid with the red line is the link. Where our model was showing would be the ideal places to build is largely where a lot of that building has occurred. So downtown Bellevue, certainly Lake Union, South Lake Union, Denny Triangle, et cetera, all in those regions is where we are showing the capacity to produce thousands of units of housing. And so that is already happening. So I think that's a positive sign. What it would look like is taking a neighborhood that was in and around 5 units per acre, which is essentially small lot single family homes, maybe with some accessory dwelling units mixed in, and targeting growth in those neighborhoods through missing middle to increase that density from 5 to 12. And the way that can generally happen is, in corridors, we can put in some missing middles. Those could be garden style apartments, those can be row houses, those can be some stacked flats. And in aggregate, that allows you to keep the single family housing in the neighborhood, and in the corridors, increase your density. In places that look more like this, and this is, I think, Wallingford today, which is around 12 units per acre, we would look to increase the density in those places to more like 30 units per acre. And I think this is an example of downtown Kirkland and Kirkland Urban project, to where we would be building more podium in those corridors and missing middle in and around those neighborhoods. And that's a way that you can achieve accessible growth within those neighborhood constructs where we could build those additional 225,000 units over a 20-year period. Statewide, this is already happening. Less than 50% of the permits that we see today, or in 2019, I should say, were single family. If we go back to 2000, and in the early 2000s, 70% or close to 80% of permits were single family. In the 3-county Puget Sound area, that's now 1/3 of units. And so what this report is testing is really reinforcing some of the market forces that we're seeing today and aligning zoning, entitlements, and incentives to allow that continue to happen so that we can provide units that are in areas of high economic opportunity and accessible to transit. I think if you look at housing affordability, 30% is that target for what people should be spending on housing. And when we look nationally, between 12 and 17% of monthly income is also spent on transportation. And so while housing is a huge component of that, transportation in some instances can be up to half of that amount. And so really understanding the benefits of building in those areas, along with continuing to build in other areas, is one way to really look at improving affordability. Within new construction, which is skewing much more towards multifamily, the other trend we're seeing is towards larger buildings. And so this chart is looking at King and Pierce County and looking at how many units were built that were 5 to 20 units, 20 to 50, 50 to 100, 100 plus. And if you go back to the 40s, 50s, and 60s, a large share, maybe even as much as 75% of what was built were in individual buildings with less than 50 units. That's been entirely flipped, whereas today, since 2010, 2015, we're seeing the opposite. 75% of all units are built in buildings with 100 or more units, and another 15% or so are in 50 units. So the share of units that are in small buildings is much, much smaller than it's ever been historically. And so from a missing middle standpoint, that's an opportunity to look at continuing to add units, which is another word for density, in places that can support that. Pause here for some questions. Is there any indication of population redistribution to lower populous areas like Spokane with remote work options? Great question. The actual government data on migration is generally released at the end of the year with some lag. And so when we're looking at what's been happening in 2019, difficult to say. And so I think one of the indicators that we have there was using real estate searches as that metric for understanding, where competitive markets are seeing and where people are looking. And so you see strong indications that people are looking increasingly, let's say, outside of the core of Seattle and into those other places. I think another more likely scenario is not that necessarily people will be moving from, say, Puget Sound to Spokane, but more reasonably that people who are migrating to Washington State from California, Texas, other places, Oregon even, might be less likely to move into Seattle than places like Spokane. And so we have some early indications of that, but don't have great data as of yet on what that might look like. Another question, has infrastructure load been taken into consideration when talking about growing up to 4,000 units in some of these areas, specifically sewer, drinking water load? And so specifically, no, but I will come back to that in a moment when we do look at what the infrastructure installation costs are for, say, greenfields new development, as well as the operations and maintenance of those new facilities versus existing facilities. And we understand that there's a big cost differential there. Whether a particular block or block group in a city has the required infrastructure isn't known, but we're assuming some standardized cost to install the infrastructure. So in essence, we are assuming that the load is not necessarily able to do that and accounting for that with some incremental costs associated with that development. But happy to dig in some of them to the more of those questions at the end. So I think the trends we want to reinforce are statewide, we're seeing a move from single family detached housing to multifamily. multifamily is largely concentrated in larger buildings with numbers of units. And then the last factor, I think, is how affordable are those buildings? And so what we traditionally hear is new construction isn't affordable. It's only available at, well above 100% of AMI. And so what this chart looks back at is, in the city of Seattle specifically, each dot is representative of a building in the year that was built and how affordable those one-bedroom units were at that time, given what the area median income was. And so if we look at 2019, on average, units were affordable at 112% of AMI. So representatively, that is a true statement that units aren't broadly affordable when they're built. Some of those units aren't even affordable at 150% of AMI. But what you will see is there are some instances of where buildings are below 100 and even closer to 80% affordability. And so while it's true on average that that's not the case, there are some benefits to affordability immediately from building new construction. I think the other point is that hasn't always been the case. And if we go back to 2000 or even through the cycle ending in the Great Recession, many units were affordable at 80% and even up to 100%. And so this has really been a trend of decreasing affordability of new construction, let's say over the last 10 to 15 years. And that wasn't always the case. And certainly I think part of the study is looking at, are there specific policy remedies or other options that can help make new constructed units more affordable immediately? So a theme in here is looking at accessible growth. And part of that is understanding how to better leverage investments in public transportation. And so the two factors that we look at from evaluating how to best leverage public transportation is, are we building in existing areas of high density or proximate to jobs? Or are we building in areas that can leverage that investment and then increase the amount of housing and employment opportunities, or ideally both? So these charts are a little bit wonky, so bear with me. But the idea here is we looked at the station areas that were built, roughly 30 or so, since 2009 using the FTA-funded New Starts programs, and looked at those two questions. And what we can see here is those red bar thresholds are kind of densities within the region. The 90th percentile for a block group in the region is about 7 units per acre. And you can see that roughly a quarter or so of those station areas were built in areas that had already very high density, some of those at 20 or close to 30 units per acre. But on the other end of the chart, you can see in the dark blue, there are places that had almost no housing density or housing proximate to those stations. And so it's kind of a mixed bag in the sense of some places were targeted where existing housing, and other places were having potentially the opportunity to add housing. And so this second chart looks at that second question, which is how much growth are we seeing? And here I think it's much more successful in the sense of leveraging that growth. Most of the station areas are in the top 25th percentile of growth in the Puget Sound region in terms of how successfully they're leveraging housing. And here you can see, the average number of units added, at 200 and sometimes over 400 units per acre, as well above the 50th percentile in the region, which would be 12, or the 70th percentile in the region is 53 units added. And so the vast majority of those station areas are growing quickly. So if we looked at those two metrics, they're leveraging the investment pretty successfully. The selection of some of those areas wasn't in station areas that already had an existing density of housing and jobs. From an environmental standpoint, that is one of the key benefits that we can look at in terms of understanding people's behaviors as it relates to driving, is strongly related to how close they live to their job and also how close they are to transit. And so just looking at transit specifically, we can see median VMT, so vehicle miles traveled per day. If you live inside a quarter mile of a transit corridor, you're looking at households are driving about 17 miles per day. Outside of those corridors, it's double that, 30 miles per day. And so if we looked at concentrating growth in the accessible growth strategy, what we would see is those 225,000 units would reduce VMT by about 36% using this strategy, as opposed to a more of the same approach. And what that means is effectively 75,000 fewer cars on the road for those 225,000 units. So that's one of the main benefits from an environmental standpoint. The second is building more housing is going to benefit the state economy no matter how you build the units. And so more of the same delivers 77 billion in GDP over a 20-year period. Accessible growth, though, delivers an additional 25 billion. So if the idea is let's build more housing, we can see there are broad benefits, but we understand that building more housing and more of the same isn't going to deliver the same amount of benefits to the state in terms of GDP or gross state product as it would in the accessible growth approach. And then similarly on the jobs front, we can see that our assumption is that we're going to ramp into production, but at that peak production, building those housing units might support an additional 70,000 jobs. So certainly in the current pandemic where we see widespread job loss, this is an important economic development tool to understand what those broad benefits are to building housing. And then the final category is fiscal. And so to the state, whether those are B&O taxes or sales tax receipts, we can see that building more housing is beneficial. However, $700 million per year, $700 million over a 20-year period, not per year, would be generated through accessible growth. And certainly to local jurisdictions, there are property tax implications there as well. So couple of other questions. Does the accessible growth model address the need for homes to accommodate larger families, say 4+ bedrooms? So specifically, we didn't model bedrooms per se, but I think that is one of the challenges that we've seen recently in trends in multifamily is that unit mix has been much more skewed towards studios and 1-bedroom units. Sometimes that can be as much as 80% of the stock of new construction. And so understanding how to incentivize the production of 2-bedroom, 3-bedroom units, I think is one of the areas for improvement. Another question, how is housing production when it is broken down by income bracket being built for with historically high levels of wealth and inequality? Are we seeing production of housing skew towards larger units, luxury condos? If this is the case, is there simply not enough income with the segments of the population that would classically sustain the market for starter homes and condos? Let's come back to that question at the end here. And then is new construction the only answer to meet the need? Manufactured housing is cheap and can be dense. However, zoning regulations prevent the ease of development. So manufactured housing, I think, is probably something similar to how you'd think about accessory dwelling units in the sense of it's not a new housing start per se, but can certainly be an important way to increase housing production broadly. And so we can come back to that as well. So let me quickly then summarize some recent developments in what's been happening related to the pandemic, and then I'll come back to any additional questions. So I think when we look at since the report, which was looking through 2017, we can see 2018 and 2019 had very strong housing production, much more so, more units produced statewide in those 2 years than we had seen at any point in the cycle. What we're seeing in 2020 is through March, permitting was tracking the same as it had in those 2 previous years. So the red line here is looking at 2020 versus the blue and the green, which are almost indistinguishable, 2018 and 19 production by month. We're on trend right now statewide to produce 15% fewer units than we did in 2019. In King County in the Puget Sound, that's even worse. King County is trending towards 29% fewer, and the 3-county Puget Sound is 19% fewer. And so you can immediately see that decrease in permitting activity directly related to in and around the times of COVID. I think a second question is, how is this impacting renter households? And so what we see here is a survey from the Census Household Pulse Survey, where it's looking at surveying renter households statewide and asking, are you current on your monthly rental payments? Going back to April, at the beginning of the onset of the pandemic, Washington State had been performing much better than nationally, to where only 8% of renter households weren't current, which was nearly in line with historical trends, versus 15% nationwide. Over the last several months, we can get data as of last week now in September, Washington is much more aligned with what we're seeing nationally, where nearly 15% of households in Washington state aren't current on rent, which is double what we saw in April versus that 17% what we've seen nationally. And nationally has been pretty consistent over the last 8 months. What is most troubling about the inability to pay rent is it varies drastically based on various demographic and economic factors. And so the entirety of the population is 15%. If we look by race and ethnicity, that's 9% for white households, 21% for Latinx households, and fully 59% for Black households. Admittedly, there's some survey error in here because of the small number of households, so we don't know that this is exactly accurate, but the trend, I think, is pretty indicative of what's happening. Similarly long, other economic factors of income or education or loss of income, you can see, certainly lower income households at 25 to 35,000 are seeing 26% of those households unable to pay rent, versus households that are earning even 50 to 75,000 are a little bit less than the trend. So this is certainly indicative of some of the challenges we're seeing directly related to the pandemic. If we look at the outlook going forward, I think the lack of stimulus is certainly troubling in the sense of the reduction of the $600 a week added unemployment benefit or the one-time payment of $1,200 per person. I think that next round is now being discussed, and certainly there's a $300 federal program now for unemployment. But if we look at the share of renter households looking forward and their confidence in the ability to pay next month's rent, we've actually seen a slight improvement in Washington state from where that was 23% of households with no confidence or slight confidence in the ability to pay rent in June. That's now at 20%. And so while the number of households who aren't paying rent is increasing, maybe the outlook is a little bit more positive despite the lack of additional stimulus. The last and maybe most important piece here, and we're running out of time, is understanding that production has increased a lot since 2017. So 2018 and 2019 were two of the strongest years for production in history. And since the report, that has skewed things quite a bit to where now in the ratio statewide would be 0.88 from 2010 versus that 0.68 before. And so that's still well below the target of 1.1. But since the study has been commissioned, there has been some benefit statewide, and you can see that in some of the measures of affordability improving since 2017, which again was probably the peak of the unaffordability. So quickly get through final thoughts here, and may not have time to get to every question. I apologize, but I'll get you my email after the fact and happy to field some more questions. So housing production was strong statewide in 2018, 2019. The pandemic is clearly reducing that production. What will be key, and this is some of the questions we've been asked, are how are migration and household formation impacted? So are fewer people moving to Washington state? Where are they moving in the state? How frequently are children moving out of parents' or guardians' homes? Is going to be important to understand what that balance in a 15% at least reduction in housing units. We'll see what that does on the migration side of things. The eviction moratorium, I think, is an important step to help stabilize households in need, and we can see that varies quite a bit by race and ethnicity and other factors. Other rounds of stimulus, including potential emergency rental assistance, I think are crucial for targeting those households most at risk, and you can see that in the data. The strength in the for sale market is, I think, going to start to limit the number of households that can afford to purchase, which will ultimately put more pressure on rents. And so what we're likely to see is, as the housing for sale market continues to be strong, that we might see some upward pressure on rents given fewer people moving out of rentals into ownership, and at the same time, the lack of production of more for rent product. The tracking and organizing, preparing for whatever rounds of federal stimulus is going to be key, I think, for local leaders. Understanding how to advocate and enhance rental assistance programs is going to be key for those at-risk households. and understanding specifically how local jurisdictions can leverage funds and calibrate incentives is key. And we've been working with many jurisdictions around the region on implementing the HB 1923, which is really looking at long-run housing needs. I think that's going to be the key going forward now through these housing action plans for individual jurisdictions on how they want to address what is known underproduction. So I think we are out of time. My email, you can see here, is wilkerson at econw.com. Happy to field any follow-up and additional questions, and enjoyed the opportunity to present today. So thanks for everyone's time, and turn it back over to the moderators.